All right, good evening, everyone, insiders. We've got a lot to go over today, so I'm going to jump right into it. Welcome. Today was a pretty wild day. So the first thing I'm going to start with is just going over what's going on in the markets. We're going to talk about our ExxonMobil trade, which is just remains a big winner. And this morning, I sent out some guidance that was dead on. We'll go over that where we stand right now for different people. We're going to go over the general markets. Some trade targets. I have one specific trade that I'm looking at, may add more, plus some deep value securities that we could be looking to add to our portfolios. So there's a lot going on tonight, and I want to dig right into inflation and CPI data. So I've been talking about this for so long, I could not pull up enough images or tweets because they're endless from the beginning of this year, starting with the call of the bear market. But I'm just going to talk about one thing specific. Just on the word sticking inflation, I ran out of space here. And today, you finally started to hear, you could look at all the dates here, which I've been saying, hey, watch, sticking inflation's coming, sticking inflation. Sticking inflation is the main issue. It's the main issue. Don't forget it's the main issue. Sticking inflation equals recession. The issue of concern is sticking inflation. I talked about how, as we moved, this was in June, talking heads will be celebrating as inflation peaks, but stay focused. It's sticking inflation will be the devastator. And it's not just the CPI number, it's sticking inflation. And I maintain that if we see sticking inflation without deflationary pressure, we're going to get nailed, but we may see deflationary pressure. And again, I said the CPI will drop again, but the issue is more about sticking inflation. And of course, I said the optimism that the worst of inflation is over, but I remain very concerned about sticking inflation. I've said this month over month over month, and you guys all know, if you know me, particularly for an insider, thank you. That obviously means that you give me a great deal of trust and a vote of confidence. You know that I hate hearsay. This is not hearsay, and I don't say something once, and I don't say it by accident. I'm convicted to what I say. That's why I don't do calls and puts, and you never know what the market's going to do. Well, if you don't know, then you're not any kind of authority. Step off the podium. I maintain that sticking inflation is what will scare everybody and will be a problem. And today, we finally got hit with the dose of sticking inflation that caused panic in the markets. Yes, the pullback was because we missed our targets, but it's what that represents. Missing our targets represents sticking inflation, right? And if you listen to what Chairman Powell said, he hinted at this and said, our biggest concern, and you guys, you could look at the dates that I was saying this, but just a week or two ago, his last speech, he started to say we are very concerned about entrenched inflation. We cannot have entrenched inflation. I use the word sticking. A lot of other people do. They say sticking inflation. He said entrenched. And when I heard that, I thought, you are getting a little bit worried. And this is what I've said is going to be the issue. Now that the markets are getting their wake-up call, and that happens because a lot of people just aren't really good at their jobs. They're just talking heads. That's why I criticize them. But as you've seen from a lot of my tweets, I don't necessarily get along with a lot of those sorts of people, which is why I'm sort of on the outside here. But this is the issue, is that inflation stuck around and we saw core inflation rise. We weren't able to knock it down. Now, there's a lot of things coming around. I feel like that cements 75-point basis hike. I don't think the markets are in a good place. We're going to take a look at some of the charts. I think that this is very problematic. We may even see, I'm now entertaining 100 basis points as a rate hike. I still think that could be problematic and maybe not the best route to go, because I'm convinced that it is going to be a crash landing and the Feds are going to over tighten. The problem being with this entire market is things work in the rears and they work in delay. So it takes time for rate hikes to trickle through the markets and have their full impact. So the markets are sort of panicking right now. And it's going to take a little bit of time for things to correct, but once they do, you're going to see deflationary pressure. And then you're going to see the Feds pivot, and this will happen eventually, but I don't think it's happening anytime soon. And it's just going to be a cluster ball of madness. So with the rate hikes, what are you getting? You're going to get pressure on earnings. You're going to get pressure on the money supply. You're going to get pressure on the supply side. And right now, the irony is that a big issue is supply. It's not just demand. You've heard me be critical of that, and this is why I think they're botching the whole thing. I've said I think it's going to be sticking inflation because once they see that, I know they're going to panic. but I don't necessarily agree with their overall strategy. What does this mean for the markets? I think we have space to go down. I think I've been saying that for a while. I said that there's more downside. I'm worried about downside. I'm worrying about sticking inflation. So you don't have to keep hearing the word sticking inflation. I can jump out of this. Oh, no, I didn't do much there. Let me close this window and we'll go right into Thinkorswim. We know about sticking inflation now. We're looking at NVIDIA, but I am going to pull up the SPY. So let me get that up right now and talk a little bit about something else. So one thing I want you guys to understand too, you probably hear a lot about the yields, the 2-year, 10-year. I've explained that. If you're a new insider, welcome. You will get an email. There is data inside of G Drive. I have stable pieces that are extremely important. So I want to explain something. The reason that I'm able to trade so successfully and take a lot of these trades, particularly within my private wealth management and my private equity fund that I manage for my stakeholders, there's a few reasons. One, of course, that I always admit right away, I'm able to be far more agile, and that is an advantage you have as a retail trader. So when I'm telling you to be disciplined, don't worry about the FOMO. Don't say, oh, we're not going to do 5 trades every day. I don't do 5 trades every day. We don't call them out that frequently, but when we call them out, there's high upside, low downside. One doesn't go your way. Don't panic, implode, and be like, let me find a new method of trading. This is terrible. That's not how you become a success. It's what kids do. They're childish. I don't like this game. I lost at this. It's not how you're going to get better. One of the things I do that I have the advantage with, that you have an advantage with, is that I could be very agile and be very aggressive. What do I mean by that? So very quickly, before we talk about some of the treasury yields and sort of our strategy there, that agileness is something that the big funds don't have. I've worked I worked at TD Waterhouse. I've spoken and dealt with a lot of people who manage large funds. I understand the institutional side of things very well. They can't exit positions the way that you and I can. So this is why they're strategic, and you see things kind of work out over days and over time, and there's consolidation periods, and then there's a bigger dump. They can't sell off the way you or I can. Even if you look at me, right? If I took all of my wealth and my private wealth clients, my stakeholders in the fund, and it took everything that we're worth, and let's say I took our biggest position, let's say I took our Tesla position at its peak, right? And I sold that off in a day, that would not dent the price of Tesla. Maybe if I did it in a silly way and I sold at market, or I sold at the bid in a 1-minute candle, you'd see a 1-minute candle go down. Yeah, that could probably happen. And it wouldn't even be a big drop. It wouldn't be like an extended drop of a candle. It would be like this. No, let me find a smaller one. Yeah, see that candle? That's what happened. Why? Because Tesla trades tens of thousands, hundreds of thousands of shares, tens of millions of dollars per minute. We didn't have tens of millions in Tesla. But my point is, if you're a multi-billion-dollar fund, a Vanguard fund, a RBC fund, a BMO fund, or Fidelity, you're one of the big giants, you can't exit your entire position. You can't be agile. You can't get in and out. The same way that trading options doesn't really work for them, right? If you come in and you take a position of, 20 contracts at $1, right? That's not bad unless it goes up to $1.50 and you make 50% on that. That's fantastic for the average retail trader. It's insignificant and pointless for a mutual fund. It's not worth the time they spend doing that, right? They move with deeper in the money. So you could be agile and use different instruments. And I've also said, that's a reason why I don't have as much of an appetite to expand my fund or take it public or become a public manager and have a traded fund that people can engage with. Because one, it's just a heck of a lot more work. I don't need to do that. It's not as interesting. And my strategy has to change. You have to change dramatically. So in a lot of ways, it is harder. So while I am critical of some fund managers, I'm the first to admit that I have this huge advantage of being agile. If you're in a fund of tens of millions, you could be super agile when you're dealing with large cap stocks. As you move smaller, it's harder. So they have that disadvantage. They also can't work options. Now, one of the reasons why things just got a little bit more difficult isn't just what we saw in the markets. And here's where we are. Here's where we closed today on the SPY, because we're going to talk about this a little bit more. Maybe I'll make that a bit more clear for everybody so you can see how it cuts through previous areas. And last time I sent you guys the boxes and showed you where we would move down if we were hawkish on the markets. So one of the things we have to talk about is the 2-year treasury yield. So I've talked to you guys about that, and there's data inside G Drive, and you've gotten the emails. Why is that important? Where's the trades? Let me explain why it's important. If you want to make money, you want to be successful. Here's what's going on. Today I sent out a tweet and I reiterated and I wrote everybody and I said, look, I am short. I sent an email this morning. This is bad. That means go short with me. Go short on large caps and you would have made money. Almost anything you could have traded, you would have made money. Well, why didn't you send out levels? Here's what it was. We had such an astronomical drop down, right? This was our drawdown. Look at the gap down. So you can't anticipate what the contracts were going to be at. That's why I needed to pull up even for Meta. I was short Meta, but we couldn't take that kind of trade. Yeah, you can have Furu Joe or Donkey Jim saying, bro, I made 900% on QQQ. If you trade like a child, you'll end up with child results, right? Those guys are mostly fake. They trade, they do paper trading. They'll take 50 trades and then they'll post one that worked out, right? Or they'll just play guessing games. You could go short here, but you couldn't anticipate where contracts were going to open. When you have this much of a drop, right? It's not just the change in price. You could use an options calculator, like I put out a video on unusual whales, but the IV is out of control. Actually, one of the reasons I said I don't want to trade the QQQ, and the QQQ dropped, I was ahead on the QQQ. I'll pull up the QQQ today. I was ahead, and there was this consolidation period. So it was about 301.20, and we got a little bit down, about 350. And we moved from, let me just pull this up. So it was about 301.20. I entered, I held from here. We got a healthy pullback, barely ahead because the premiums had spiked so much. The implied volatility, which is what I always talk about. And I expected that. I was just looking for a bigger dump off in the moment. Obviously, we got it here. But I traded Meta, Amazon, as I was calling out throughout the day and just saying, like, this is what I'm in. To insiders, I want to be try to be a little bit more specific, but you had the insight, and this is why I teach you guys these things so you can crush it, right? You need to be able to take the clear signals, and when we have these blueprints and breakdowns that it's an economic breakdown, we missed by massive proportions. If you look at what I sent out as my projections, we were nowhere near, and I've sent out blueprints before saying when we miss, it's like an earnings call, right? It's a disappointment, it drops. So the IV was so high, right? The implied volatility was so high, the premiums were jumping so much that even as I made a move down here on my initial trade, I pulled up a little bit. I stopped out, or I didn't stop out. I exited the position because I didn't like the way the contracts weren't moving because the implied volatility was changing the prices. But on other trades, of course, we saw Meta, right? And some entry points here. Here's a call out from this morning. I wanted to move up, didn't get it. Moved in at consolidation. That's great. Out here, you could take this, put some runners on, take a little bit more of a profit. Apple, right? See different entry points here. Lots of trades for the day. But again, I said, look, throw a dart and you're going to be right. How do you know that? Okay, so what does today mean? One of the things that we saw, and I've already taught this in Insiders, and remember the point here is I'm going to provide you with alerts, but it's also to make you a better trader, right? Like, make you a better trader. I spent tens of thousands of dollars to become a better trader, and let's also include the fact that I spent 20 plus years of my life so far to become a better trader. And the first X amount of thousands were just jerks selling seminars. Back in the day, it was actual physical seminars you had to go to as well, not just getting something recorded. And they didn't want to give you DVDs. It was like, you're going to go sell it on eBay. So you go in person and just get jerked around because that's what jerks do. They give you bad information. Whereas I'm here, even in this program, I know this program is very discounted for what I'm teaching you how to be a trader and think like a professional. So what is a big element? The treasury. The treasury yield on the 2 is now touched over 3.8% today. What does that mean? That means on a 2-year treasury, you can get 3.8%. That's guaranteed safe money, right? So what does that do? Why is that a big deal? Why is that bearish, Peter? I'm trying to help you understand because I want you to get from this program value that is worth tens of thousands of dollars in 20 years of experience, right? Not just Furu Joe's, join the Discord, bro, we printing today. That's not professional. You're not going to build wealth. You'll be in and out, and if you're doing this for fun and it gives you a thrill, knock yourself out. Take 50 trades a day. But the reason that 2-year treasury yield is such a problem, why it's always signaled a recession is because now the benchmark is higher for stocks, right? So if you look at a stock, and of course, something like Apple, you're going to say, look, I expect to grow more than 3%, but we hit 3.8% today, right? Let's take that as our benchmark and just assume the 2-year treasury is at 3.8%. Okay, that means Apple now has to outperform that. That means any stock that you're buying has to outperform that. And you couple that with concerns of rate hikes, tightening the money supply, potential job losses, potential consumer recession, right? So this all puts downward pressure on Apple's earnings. And I'm just picking on Apple here, but apply this to every stock. I want you guys to understand what I'm saying. Bearish, people are going to take off risk, they're going to sell. This was not a good result, okay? So all these pressures are pushing down. We could have a consumer recession, right? People have less money, people have less jobs, right? Inflation is outpacing wage growth. The feds are tightening. They're going to tighten us into a recession. They're increasing the cost of money. And as that's happening, right, that's already putting downward pressure. Something is becoming more attractive. This is happening with the 2-year. So the 2-year goes from where it was in March at like 1.5%. You're like, it's not so attractive. I still think Apple will outperform it, even though the economy's kind of tough. Oh, there's more pressure on Apple. I still think it'll do better, but that 2-year is at 2%. Maybe I don't want that. Okay, now there's even more pressure on Apple and more pressure. And that 2-year bond our 2-year treasury is now 2.5%. And you're thinking, I'll stick with Apple. Okay, more trouble, more pressure. 3% is being offered to you. 3.5%, more problems for Apple. There's a 75 point, perhaps 100 basis point hike coming. More pressure on Apple. Now you're getting 3.8%. At what point do you say, forget this? I'm putting my money somewhere safe, right? Now, you're not going to beat inflation at 3.8, but it's safe money, and it's a good hedge against inflation because as inflation comes down over time, if they hit their target rate of 2%, look where you would be. Like if we assume that the Fed gets anywhere near 2%, you're now ahead of inflation with safe guaranteed money. Put your feet up. You don't have to worry about it exiting a position. You don't have to worry about a market crash. You don't have to worry about BRICS competing with the United States or with NATO. You don't have to worry about all these different conflicts. Kick your feet up. Take your 3.8%. And what are you going to do if you have massive wealth? You might just say, hey, you know what? Yeah, all right. I'll put my money in there because one thing I want you guys to remember as well, that inflation is to an extent contingent upon consumption, right? So it only impacts you, or there's a sliding scale in which it doesn't impact everyone equally. The more you consume, the more you're exposed to inflation. The less you consume, the less you're exposed to inflation, right? So if you're paying for rent or you're signing up for rent now, you're getting clobbered. If you own your house, it's a different story. Now, yeah, you'll still pay energy and all that other sort of stuff. But your big costs, or if they're behind you, you're not exposing yourself into the pool of inflation. So if you have billions of dollars, presumably you don't have a mortgage. Although I remember a story when I was younger, like 10 years ago, Mark Zuckerberg took out a mortgage, something like he was worth $100 million, but he took out a mortgage on his house. I can't remember the details, but presumably you don't have a mortgage. What are you going to do? You're going to want to park your money, right? This is safe money. So the 2-year going up like that puts a lot of pressure on stocks. So this is why the market is in a difficult place right now. I don't think you're going to get that lower print next month on inflation. I was concerned about sticking. I don't think we have to go back to that image of me saying sticking inflation. I was concerned about that. I don't think that you'll necessarily get a much better print. We were worse off on core, and it takes time for that to kick in. Now, where the feds are going to mess up, in my opinion, is that it's all a trailing effect. So when it all flushes through, I think that you're going to get some heavy deflationary pressure, and that'll come in the form of shelter because the housing market's already in a recession, but we haven't seen seller capitulation, meaning sellers just are being stubborn and saying, well, we'll kind of drop our prices, but they're not at that desperation point. I've said before, if you're in that housing market, and this one video from insiders could change your life and change your finances. So pay attention. It's buyer capitulation. People won't sell if they're sitting on a lot of equity and they have no reason to sell. They're just not going to capitulate. If we go into a recession where people lose their jobs, put inflation aside, all bets are off. You lose your job, you can't afford, everything's off the table. You can't afford your house with the energy bill and all the other things that are pressuring you. So that's when you see the heavy sales. So with the way that the Feds are pushing things, we might see a rapid decline in the housing market, which would add deflationary pressures, and then sort of we run through that some of that supply glut, and hopefully we see some improvements, although I don't see that a silver lining just yet for energy. Okay, so you understand my overarching position in the markets right now. You have a little bit of a better understanding. You can go. So what you want to do with that is go start your own, start a Twitter account and buy 20,000 followers. Open up a Discord and just start saying what I just said. It's a furu joke. That wasn't my best. Okay, so let's look at the markets here. So where are we right now? So right now, of course, close at 294. Remember, the low of the year was 269. I think we're in a worse position. The market's in a deeper realization of what's going on. Same thing here you see with SPY, bottomed at 362. I don't think we necessarily break below the lows of the year. I think there was a little bit more panic here, but that wasn't that long ago. Keep in mind that was in June. So overarching position, yeah, I think we have space to come down. Are we going to see rallies? You guys have seen how I've done things, right? I've given the breakdown of how a bear market breaks down, right? So when it breaks down, you have these rapid big drops, but you get more up days. You probably see a little bit more green here, right, than you do red. And that's because we usually have more up days and we have tons of rallies in a bear market. So more up days in bear markets than there are down days, but the down days are so much more aggressive. Like if you look at it, just look here. When you're seeing the big pieces, right? You see some solid moves up, huge move down, right? And then it's green with a little bit of red, pull back up and pull back, consolidation, and then just absolute devastation, like down. This was a chaotic period here, but just fast drops down, huge drops down. This even gap down. This is massive gap. And then you saw massive gaps. So that's the way we break down. I want to talk about a few securities right now as well to add to our call out list. And again, I really, really want to drive this education, take you guys to a different level. And remember, be smart. Don't end up out of the game. The one thing that knocks traders out is they don't survive the early phases because they get overzealous and they feel like, I'm not making enough money from this. If I started your job, whatever you do as a professional, I would probably have to be in school for several years before I made a penny. If anybody's an engineer, software engineer, if you're a nurse or anything, I can't just go to school for 2 weeks, come out and make a ton of money. So if you're making money and you're doing it at a pace where you think, I'm not rich and balling out like Furu Joe, just remember, you're new to this profession. Yes, I'm helping you fast track your education, but be smart. Don't burn out taking silly trades or doing things or being too aggressive or feeling like you're not going quickly enough. You'll bounce around. You'll go look for the Holy Grail. You'll be out of the market within a year. Don't do that, right? I've seen too many people come and go, even professionals in my space. And it's sad. I've seen professionals quit this industry because being in this industry gave them too much temptation to actually trade in their personal lives. Meaning they couldn't work as a professional and abstain from trading recklessly personally. So they just quit the industry because it was ruining their lives, because every paycheck they had was going to their trading and then they were just blowing it up. And guess what? That was me for a little while too. I didn't quit because I'm stubborn. So let's take a look here at NVIDIA. I think that there's room to go down. I'm setting a price of 134.05. I'm going to send out some contract ideas when I do send this email out. And you know the strategy. You can go deeper in the money wherever you like. Now, one thing you're going to notice, NVIDIA is already at their 52-week low, right? So if we pull this up and I go to 1 year daily, here's NVIDIA. Here's where we closed today, right? After a bit of consolidation period, see a gap down. But what about AMD? AMD is not at their mad. AMD, you mad, bro? Mad money, Jim Cramer. So AMD, not at their 1 year low. That was down 71.60, right? I knew that because I keep up with all these different securities, or as many as I can, and then we have files and documents on others. So AMD isn't at their annual low. It's semiconductor. So is NVIDIA. So why am I picking on NVIDIA? Well, there's this idea that you can't go lower than your low, which is crazy talk because that's how new lows are made. I don't think NVIDIA is a poor company or a bad company in the future. And I would say at this point in the markets, if you had the appetite and you can hold off for 3 years, buy everything. Buy everything in sight right now. you can get to that point. You might take a 20-30% drawdown, but there's more than likely that you're going to increase 40 to 60% over the next 3 to 5 years. I know that most people here don't have those sort of timelines, and I could tell you my fund doesn't have that level of patience. That's not how I don't have that level of patience. That's deep value. So what is it about NVIDIA? We've prospected. Well, NVIDIA has a different story than AMD. AMD has really grown their cloud business. I also have concerns that you've seen my crypto paper. The reason I left that in G Drive, even though we're not making trades on that, is just for precautionary reasons, and also because I like the idea of the merge on Ethereum, but I think that takes away a lot of business for NVIDIA. And remember, and I'm tight with the market, so maybe I remember this because this is the kind of stuff I like to talk about. I speak to my friends, my wife, everybody when I run out of things to talk about and I want to talk about stocks again. But NVIDIA did something silly, and they misreported their numbers, and they then admitted that they kind of fudged the numbers in terms of bifurcating their mining sales versus their gaming sales. Now, I'm not accusing them of anything, but I think they were fined for that not long ago. And I do understand it's a challenge, but I think they're going to lose a lot of that mining business with the recent merge in NVIDIA. Recent merge in Ethereum. That also makes Ethereum interesting. That's the only crypto that I am interested in. And there are also regulations coming down on the semiconductor space again, which is why I held off on AMD, even though it was one of our targets. Once that got announced, I canceled the trade in the morning. I had received some information from one of my partners and colleagues that there's concerns that it is not simply going to be China, but there's going to be expansion on the regulations and restrictions to where NVIDIA and AMD can sell. And that we're going to tighten up globally a little bit more. So I was concerned about that. We want to withdraw. Whether or not that's overly impactful depends on which countries are restricted and how they're restricted. But it's just not the time for me. AMD remains interesting. NVIDIA is a short at 134.05 tomorrow. And I'm looking for it to get up to that price at least, even though we're overarching bear, because I am expecting some short coverings and a little bit of a bounce up, right? So we're going to have some short covers, some discount buyers. I'm sure you'll see the markets move up, but perhaps not in earnest. So that is NVIDIA. We're going to talk about one more here. We did look at AMD, right? And keep an eye on some of the on the Twitter trades. I'll update in the AM on that as well. But we're trying to take smart plays here. That's right. The one I want to talk about before AMD is XOM. So XOM, ExxonMobil, closed down today. We're all ahead. If you're on an underlying trade, right, you can move your stops up. Make sure that you make some money here, 4 or 5%, in a good sized position as most people did. You can move up to 94.50. That gives you 2 points because we got in on an average of 92.50. I'm holding longer, but one thing I sent out this morning, I wasn't saying it's going to have a phenomenal day. What I said is I don't want to sell it open. I do not want to sell it open. We're going to rebound. This is a different story. We're going to do a little bit better. Yes, we're down 2 points, but if you look over the past few days, we're not that far off where we were just 2 days ago. So this is not the same kind of pullback you saw in the other securities. But I sent out a notice to everybody, right? Because I want everybody to make every single last penny you can. I said, exit as you wish, but I don't like the idea of selling it open. I think it's bad timing. I think we're going to move up. We're going to get back into a better place. And so does that make you a fortune? Well, here's where we open. And we got right into that 97 territory. And this is a 15 minutes. So let me go to the 1 minute. We spent a while there. This is what I was trying to say. Well, this is what I was pretty clear in saying. I kept saying not at open, not at open, not at open. This was open, 96.61. You got 97.65. 97.50 as high as 97.80. So about 1 dollar. If you're trading options contracts, that was a fortune to you. And that's what I do. I've got your back. Did I use my slang properly? I got your back. Do people still say that? I wonder if people still say that. I think they do. If you're trading the underlying, 1 point is 1 point. If you bought 100 shares, that was $100, right? So I wanted everybody to have a good exit opportunity if you're so inclined. And if you have a built position you've averaged in from lower prices, have been calling out since 74, then you're cruising, right? You can trim as it starts to pull back, but you're in a good position. But that's why I sent that out. This is a different story. I knew that ExxonMobil wasn't going to pull down unless the markets really started to break down, and I knew we'd have an early opportunity because early on people are feeling that this story should not be going along with the markets. It wasn't until the markets really started to bleed that investors got panicked and said, hey, even with a value stock, maybe I'll take a little bit off, free up some cash here, and adjust our strategies. So that's ExxonMobil. And back to AMD. Not a buyer right now. AMD is a company that I like. I want to see this settle. I think the area for me is to get much closer to retesting the lows. We're there. We're close. We're in the 70s again. I want to see us retest the lows. That's where I might take a long position. So I will update. That's not the exact low. Low is 71.60. I will update on that. Hopefully this is a bit of a different feel. I thought we would just talk through it and give you a little bit more insight on what do we look at. Obviously within the fund with my partners, we do a lot more calculations on the back end side. Some of that is, with our cash flow models and sort of our value models, it's proprietary and exclusive to the fund. I hate the word proprietary. It sounds like you're in a laboratory, but it's trades you to the fund, and I can't disclose what other people are saying. However, I can give you my analysis and help you get a deeper understanding and help you understand the markets. We talked about the treasuries. We talked about where we're going with the markets overall, what my overarching position is. I think that there is more downside in this market. And again, let's not forget, we look at the QQQ and SPY, right? We're nowhere near the bottom. I don't know if we necessarily retest quickly, but this is downward pressure. I don't think the Feds ease up until they break the system. And the last one, let me throw this last one in there. One stock we will be talking about, you're going to think I'm a weirdo here, Zoom. Zoom is, sitting right near its 52-week low, but Zoom has been making money consistently. And it's not contingent necessarily on the pandemic because it's now entrenched. It is the industry leader for, teleconferencing. So we'll have more on that later. This is more of a deep value, longer play. But I do like that they're making money. They've kind of bottomed out. I was critical of Zoom and I said, this is a post-pandemic crash stock. And I was talking about that, maybe when Zoom was about 140, 130, half the price now. And if you look at where it was, nowhere near. Appropriately so to an extent, but they're sitting on a lot of cash. They're earning money. So we'll talk about that in the future. This has run on for a little while, and I know everybody's going to try to watch this before the markets tomorrow. So I will add the trade idea. I will add in writing. And then this is something that you guys can all watch to learn more and become better traders. And I promise you there's more to come. I'll keep working with you, and we will progress to cram as much knowledge in as possible. All right, everybody. Talk to you soon.